There is an account somewhere with your name on it that you have not thought about in years. An old savings bond in a drawer, a retirement account at a company you left decades ago, a policy you bought in the 80s and stopped watching. And here is what almost nobody knows about accounts like that. Sitting still is not safe. There are 5 specific accounts where doing absolutely nothing is the single most expensive choice available to you. Not spending it wrong, not investing it wrong, leaving it alone. One of them can generate a tax bill on money you never touched and never received. One of them can be taken by your own state, and the taking itself creates the tax. One of them stops paying you entirely and keeps sitting there quietly while you assume it is still growing. And every one of these has the same shape. Nothing happens for years. Then one line on one tax return and thousands of dollars are gone. And I want to explain why that shape exists, because once you see it, you will recognize it everywhere. Almost every account in this video was built with a tax deferral inside it, money that grows without being taxed along the way. That is genuinely a good feature. It is why these accounts exist and why people were told to use them. But a deferral is not a forgiveness. It is a delay. And the longer the delay runs, the bigger the pile becomes, until one day the pile stops being deferred and lands all at once. So the very thing that made these accounts attractive when you were 50 is the thing that makes them dangerous now. Nothing about them changed. Only the calendar did. Now stay with me, because there is one more thing. For most of these 5, the entire problem disappears if you act before the calendar year closes. Not a form, not an application, a decision, made in the right year instead of the wrong one. Before this video ends, I will tell you which of the 5 cost the most and exactly what the deadline actually is. My name is Kevin. I read the rules so you do not have to. If you are new here, this channel exists for one reason. We read the fine print that decides what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell, because at least one of these 5 is probably sitting in a drawer in your house right now. Before I start, one honest word about who this video is for. You do not need to have all 5 of these. Almost nobody does. If you have one of them, this video is worth your time. If you have none of them, you will still know what to look for on behalf of somebody you love. I am not going to spend 30 minutes describing a rich person's portfolio. Every account in this video belongs to ordinary people, and most of them were opened when the person was much younger and thinking about something else entirely. And one more thing before I start, because I have gotten this wrong for people before, and I want to be clear. I am not going to tell you the government is coming for you. That is not what this is. Nothing in this video is a new law aimed at seniors. Every rule I am about to describe has been sitting in the tax code for years, working exactly the way it was written. The danger here is not malice. It is silence. These rules are not hidden and they are not new. They are simply never explained to the person they land on until the year they land. Let me start with the one hiding in a drawer, savings bonds. Millions of American households have them. They were bought as gifts, bought at work through payroll, bought for grandchildren, bought during wartime drives generations ago. And they sit in envelopes, in safe deposit boxes, in the back of a filing cabinet, doing what everybody assumes they are doing, growing quietly. Here is the first thing almost nobody knows. A savings bond does not grow forever. Verified card, source, U.S. Treasury. Savings bonds reach final maturity and stop earning interest. Every one of them has a final maturity date. When it arrives, the bond stops paying interest completely. It does not shrink, it does not disappear, it simply stops. And here is what makes that so costly. Nobody sends you a letter. There is no notice in the mail that says your bond stopped earning last Tuesday. The paper looks exactly the same in the drawer as it did the day before. And there is a common mix-up worth clearing up right here, because it costs people years. There is a difference between a bond reaching final maturity and a bond simply being old. Some series stop earning at a set number of years, others keep going longer. And the rules were different in different eras, so 2 bonds bought a decade apart can behave completely differently, which means you cannot go by feel on this. A bond does not look retired, it looks like a piece of paper. The only way to know is to check the series and the issue date on each one, individually. So there are households in this country holding bonds that stopped earning years ago, in some cases many years ago. Every one of those years, that money sat there earning nothing, in an envelope, while the person holding it believed it was quietly building. Now here is the second half, and this is the part that turns a missed opportunity into an actual tax bill. The interest on those bonds is not taxed as it accumulates. It builds up untaxed year after year for as long as 30 years. Verified card. Source, U.S. Treasury. Savings bond interest is generally tax deferred until redemption or final maturity. That sounds like a gift, and for a long time it is, but that tax does not vanish. It waits, and all of it comes due at once, not spread across 30 years, in a single tax year, which is why the timing of when you cash them matters enormously. If you redeem a stack of long-held bonds all in 1 year, every dollar of accumulated interest lands on that one return. Let me tell you about Rufus. Rufus is 76. He lives in Poplar Bluff, Missouri. He worked in a shoe factory for 22 years and then drove a school bus until he was 70. His mother left him savings bonds. He added a few of his own over the years through payroll at the factory. He needed a new roof. So he took the whole envelope to the bank and cashed all of them. The money was good. The roof got done. Then the tax form came. Decades of accumulated interest reported as income, all in that single year. It pushed him into a higher bracket. It changed how much of his Social Security got taxed. And 2 years later, it raised what came out of his check for Medicare. One envelope, one afternoon, one decision made on the wrong day, and the ripple went through 3 separate parts of his finances. And the worst part is what he could have done instead. If he had cashed a portion in 1 year and the rest in the next, that interest would have been split across 2 returns. Same bonds, same roof, same money. A meaningfully smaller tax bill because the income landed in 2 years instead of 1. And there is a second thing about Rufus that I want to be careful about because it applies to almost everybody watching. He was not just pushed into a higher bracket. That was the smallest part of it. The bigger damage was everything downstream. More of his Social Security became taxable that year because the interest raised the income figure that decides that. And 2 years after that, what came out of his check for Medicare went up as well. None of those 3 things is enormous on its own. Together, on a fixed income, they were the difference between a comfortable year and a tight one. That is why the timing question matters so much more than people think. A single decision does not just cost you the tax on that decision. It moves everything that sits on top of it. That is the entire pattern of this video, and you are going to see it 4 more times. Not what you own, when you move it. Now here is what to actually do about this one. Find the bonds, physically, this week. Check the issue date on each one and find out whether it has reached final maturity. The Treasury has tools for this, and any bank that handles savings bonds can help you read them. If any of them have stopped earning, that money is doing nothing at all and should be moved. And if you have a large stack of them with a lot of accumulated interest, do not cash it all in one afternoon like Rufus did. Talk to whoever prepares your taxes about spreading the redemptions across more than 1 year before you cash a single one. Now the second account, and this one can be taken away from you entirely. An old retirement account you left behind. Almost everybody who worked for more than one employer has one of these somewhere. A retirement account at a job you left in 1994. A small balance at a company that has since been bought twice and renamed. You know it exists, vaguely. You have not received a statement in years. The address they have for you is 2 houses ago, and you assume it is fine because where would it go? Here is where it goes. If an account is inactive long enough and the company cannot reach you, it can be turned over to your state as unclaimed property. Verified card. Source. Dormant accounts may be escheated to state unclaimed property programs. That is called escheatment. And for most kinds of accounts, it is not a disaster. The state holds your money, you can claim it back. But for a retirement account, something else happens on the way out. When a retirement account is escheated to the state, the Internal Revenue Service generally treats that as a distribution. Verified card. Source. IRS guidance treating escheatment of an IRA to state unclaimed property as a taxable distribution. Confirm current guidance before recording. A distribution means taxable income in that year, whether you asked for it or not. Now, sit with that for a second because it is genuinely one of the strangest things in this entire tax code. Your account is taken because nobody could find you, and the taking itself creates a tax bill in your name on money you did not request, did not receive, and did not know had moved. But you can still claim the money back from the state. That part is true and it matters, but the tax event has already happened, and the tax shelter that account had for decades is gone. It does not go back into a retirement account when you claim it. But let me tell you about Leota. Leota is 71. She lives in Anderson, Indiana. She worked at a regional insurance company for 9 years in the 80s before leaving to raise her children. She left a small retirement account behind. She always meant to deal with it. It was not large, and life kept being busy. 2 moves, and 30 years later, the company had been acquired, her maiden name was on the account, and every statement they mailed went to an address where a completely different family now lives. The account went dormant. Then it went to the state. She found out from a tax document she did not understand. Money she had never touched, reported as income she never received, in a year when it pushed her into a higher bracket for the first time in her life. And here's the part that stings. The entire problem was a mailing address. Not fraud, not a bad investment, not a market crash. An address and a maiden name and 30 years of not looking. So here is the action, and it is genuinely one of the highest value hours anybody watching this can spend. Make a list of every employer you ever had where you contributed to a retirement plan. Every one, going back to your first real job. Then find out what happened to each account, whether it was rolled over, whether it was cashed out, whether it is still sitting somewhere, and search your state's unclaimed property database. Every state has one, it is free, and it takes about 5 minutes. Search under every name you have used, including a maiden name. Do that before your name shows up in it, not after. And there is one more habit that prevents this entirely, and it takes about 10 minutes a year. For every financial account you hold anywhere, make sure they have your current address and a current phone number. That sounds too obvious to say out loud, but every escheatment story in this country starts the same way: mail that could not find somebody. The people most exposed to this are the ones who have moved recently, changed a name through marriage or divorce, or left a job decades ago at a company that has since been acquired. If any of those describe you, the risk is not theoretical. It is simply a matter of whether the mail happened to keep up with you. Now I want to stop here because Leota is the exact reason I built the thing I am about to tell you about. She did not lose that money to a mistake. She lost the tax shelter around it because a piece of mail could not find her, and there is no agency in this country whose job it is to warn you about that. Nobody calls. The letters go to the wrong house by definition because the wrong address is the whole problem. That is what the Quiet Rules is. It is the drawer version of everything I cover on this channel. Written large, written simple. How to find accounts you left behind, where to search and what to search under, what to check on an old bond, what to do before you cash anything so the timing works for you instead of against you. So the person going through a filing cabinet on a Saturday knows what they are looking at, instead of finding out from a tax form 18 months later. The paper remembers for you. That is the entire point of paper. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top, and there is a 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. Because the alternative is a woman paying tax on money she never held over an address change she made 30 years ago. If nobody has ever told you an old account can be taken at the same time, do me one favor. Subscribe and turn on the bell, because this channel reads the fine print that nobody mails to your house. Now the third account, and this one is the most misunderstood thing in this entire video. An annuity you bought with regular money. Not inside a retirement account, just money you had. A lot of people bought these in their 50s and 60s. Somebody at a bank or an insurance office explained it. It sounded safe, it grew without being taxed each year, and it has been sitting there ever since. Here's the part people get wrong. The growth inside it is not tax-free. It is tax-deferred. Verified card. Source. Earnings inside a non-qualified annuity are tax-deferred, not tax-exempt. Those two words look similar, and they mean completely different things. Tax-free means never taxed. Tax-deferred means taxed later. And later has a way of arriving at the worst possible moment. Now here is the specific trap, and it catches almost everybody. When you take money out of one of these, you do not get to take your original money out first. Most people assume the opposite. They assume the money they put in comes out first, tax-free, and only later would they be touching gains. That is not how the rule works. Verified card. Source. Withdrawals from non-qualified annuities are generally treated as coming from earnings first. The gains come out first, all of them, and every dollar of that is taxed as ordinary income, not at the lower rates that apply to long-term investments, at ordinary income rates, the same rates as a paycheck. Let me tell you about Cordelia. Cordelia is 73. She lives outside Cape Girardeau, Missouri. She put money into an annuity 19 years ago. It has grown substantially since then, which is exactly what she wanted. Her air conditioning failed in July. She needed a real amount of money quickly, so she took a withdrawal from the annuity. In her mind, she was taking out her own money, the money she put in 19 years ago. But under the rule, she was taking out gains, every dollar of it, taxable at ordinary income rates in that year. She had planned for a repair bill. She had not planned for a tax bill on top of it. And there was a second layer she did not know about either. Many of these contracts have a surrender period, a stretch of years early on where taking money out costs you a penalty paid to the insurance company itself. Verified card, source. Many annuity contracts impose surrender charges during an initial period. Cordelia was long past hers, so that did not hit her. But for somebody who bought one more recently, that penalty and the tax can land in the same month. So here is what to do about this one, and it is simpler than the rule sounds. If you own one of these, call and ask for two specific numbers, what you put in and what it is worth now. The difference between those two numbers is the taxable part, and it is the part that comes out first. Knowing that number before you need money is completely different from finding out after you have already taken it. And if you know a large expense is coming, talk to somebody about which account it should come from, because pulling from the wrong account in a year when your income is already high can cost you far more than the same withdrawal in a different year. And there is one more thing about these contracts that I want to mention because it affects what your family inherits. When an annuity like this passes to somebody other than a spouse, the built-up gains do not get the same treatment that many other assets get at death. Verified card. Source. Gains in a non-qualified annuity are generally taxable to the beneficiary and do not receive a step-up in basis, which means the tax that was deferred all those years does not disappear when you do. It moves to whoever receives it. That is not a reason to panic, and it is not a reason to cash anything out in a hurry. It is a reason to know, so nobody in your family is surprised by it at the worst possible time. Now the fourth account, and this one has a deadline attached that catches people right at retirement. A health savings account. If you ever had a high deductible health plan, you may have one. Many people do, and many of them treat it as a small account for dentist bills and glasses. But it is the most tax-advantaged account in the entire tax code. Money goes in without tax, it grows without tax, and it comes out without tax when used for medical costs. Verified card. Source. IRS. Publication 969. Health savings accounts. 3 layers. Nothing else in American finance does that. Now here is the trap, and it is a timing trap, which is why it belongs in this video. It involves Medicare. You cannot contribute to one of these once you are enrolled in Medicare. That part is fairly well known. Verified card. Source. IRS. Individuals enrolled in Medicare may not contribute to an HSA. But here's the part almost nobody knows. When somebody enrolls in Medicare after 65, coverage for one part of it can be applied retroactively, backdated, several months into the past. Verified card. Source. Medicare Part A coverage may be applied retroactively for individuals enrolling after age 65. Confirm current retroactive period before recording. Now think about what that does. You were contributing to your health savings account in good faith. You were not on Medicare yet. Everything was correct on the day you did it. Then you enroll, and coverage is backdated into the exact months you were contributing. And now those contributions are excess contributions, retroactively, through no fault of yours. Excess contributions carry a penalty for every year they stay in the account. Verified card. Source. IRS. Excess HSA contributions are subject to an annual excise tax until corrected. Let me tell you about Amos. Amos is 68. He lives in Chillicothe, Ohio. He kept working past 65 because he liked the work and the insurance was good. He contributed to his health savings account right up until he retired, exactly the way he had for years. Then he enrolled in Medicare, and the coverage reached backward into the months he had been contributing. Months of contributions that were perfectly legal when he made them became excess contributions after the fact. There is a process for fixing this. There is a way to withdraw excess contributions and correct it, and there are deadlines attached to that too. But Amos did not know any of it had happened until his tax preparer told him the following spring. By then, the correction was harder, and the penalty had already started. So the rule to carry out of this section is short. If you are past 65, still working, still contributing to one of these, and you are anywhere near enrolling in Medicare, stop contributing several months before you enroll. Ask about the retroactive period specifically. Ask it out loud, by name, before you file anything. And there is a genuinely good side to this account that almost nobody uses, so I want to give you that too. After 65, you can take money out of it for anything at all without a penalty, not just medical costs. Verified card, source IRS. After age 65, HSA withdrawals for non-medical expenses are not subject to the additional penalty. You still pay ordinary income tax on non-medical withdrawals, but the penalty that applies before 65 is gone. Which means after 65, that account works something like a retirement account with a bonus, fully tax-free for medical costs and available for anything else at ordinary rates. Most people have no idea that flexibility exists, and they leave it sitting there untouched while pulling from accounts that cost them more. And there is one more feature of this account that almost nobody uses, and it is remarkable. There is no deadline on reimbursing yourself. If you paid a medical bill out of pocket years ago and you kept the receipt and the account was open at the time, you can generally reimburse yourself from it later, even much later. Verified card, source IRS HSA. Distributions may reimburse qualified expenses incurred after the account was established, with no specific deadline. Confirm current guidance, which means a shoebox of old medical receipts is effectively a stack of tax-free withdrawals waiting to be taken. Most people throw those receipts away. The people who keep them have quietly built themselves a source of money they can pull, tax-free, in any year they choose. That is the kind of thing nobody ever tells you, and it costs nothing to start doing today. Now the fifth account, and this is the one I promised you costs the most. An old workplace retirement plan you never rolled over. Not one you forgot about like Leota's. One you know perfectly well is there. You get the statements, you just never moved it. And here is why that matters far more than people think. While that money sits inside a former employer's plan, the plan's rules govern it, not your rules. Which means the plan decides what withdrawal options you have. The plan decides what investments are available and what fees come out. And the plan can have provisions that do things to your account without asking you. The most common one catches small balances. If your balance is under a certain threshold, a plan can move it out on its own after you leave. For very small balances, it can be cashed out entirely. Verified card, source. Retirement plans may force out small account balances after separation from employment. Confirm current thresholds before recording. And a cash out is a taxable event. Money leaves a retirement account, tax is owed, and if the person is under the age where penalties stop, a penalty comes with it. Let me tell you about Hollis. Hollis is 66. He lives in Enid, Oklahoma. He worked at a manufacturing plant for 6 years in his 40s before moving on. He left a modest balance in that plan. He always knew it was there. The company restructured its retirement plan, and under the plan's own rules, small balances belonging to former employees were moved out. A check arrived. Hollis, being practical, deposited it. And in doing that, without meaning to, he converted retirement money into ordinary taxable income in a single year. There is a window to move that money into another retirement account and undo the tax consequence. He did not know the window existed. By the time anybody explained it to him, it had closed. And I want to say clearly what he should have done, because somebody watching this is going to be in his exact position within a year. If this has already happened to you, and the enrollment is done, and the contributions are sitting there, it is not automatically too late. There is a process for removing an excess contribution, and there is a way to handle the earnings attached to it. The penalty is annual, which sounds terrible, and is actually the good news. It means the sooner it is corrected, the less it costs, and it stops the moment it is fixed. What you cannot do is nothing. An excess contribution left alone does not resolve itself. It simply charges you again next year, and the year after that, quietly, forever. So here is the action for this one, and it is the simplest on the list. If you have money in a plan at a company you no longer work for, decide deliberately whether to leave it or move it. Deliberately, not by default, because leaving it is not neutral. Leaving it means the plan's rules govern your money, and those rules can change without your input. And I want to be fair, because sometimes leaving it is the right call. Some workplace plans have genuinely excellent investment options at costs an individual could never get on their own. Some have protections that are stronger than what you would have elsewhere. So this is not a video telling you to move everything. It is a video telling you to decide. The problem is never the choice you made. The problem is the choice that got made for you, by default because nobody ever looked. And if a check from a retirement plan ever arrives unexpectedly, do not deposit it into a checking account and think about it later. That is the most expensive reflex in this entire video. There is a limited window to get that money into another retirement account, and once it closes, it is gone. Now let me pay off what I promised you at the start. I said one of these 5 costs the most, and I said I would tell you what the deadline actually is. The most expensive one for most households is the annuity, because the gains come out first at ordinary rates, and the amounts involved are often large. But the deadline is the more important half of that sentence. Here is the honest version, and I am not going to dress it up. There is no single law changing on one specific morning that reaches into all 5 of these. What there is the tax year. Every one of these 5 is decided by which calendar year the money moves in. Cash a bond in December, it lands on this year's return. Cash it in January, it lands on next year's. Take an annuity withdrawal in a high-income year, it costs more. Take it in a low-income year, it costs less. Which means the deadline is real, and it is the same one it always is. The turn of the calendar. Everything you decide before that turn lands in one tax year. Everything after lands in the next. And for accounts like these, where an entire decade of untaxed growth can arrive in a single line, that difference is the whole ballgame. Now let me put the arithmetic together so you can see what is actually at stake. Take one household that has 3 or 4 of these 5, not a wealthy household, an ordinary one. A stack of bonds cashed all at once instead of spread across 2 years. Call the difference $9,000. An annuity withdrawal taken in a year when income was already high instead of a year when it was not. Call that $11,000. An old account escheated to the state, forcing a distribution nobody asked for. $14,000. A forced cash out from an old plan, deposited instead of rolled over. $5,000. And an excess contribution penalty on a health savings account, running for more than 1 year before anybody caught it. $2,000. That is $41,000. Not from bad investments, not from a market crash, not from spending too much. From 5 decisions about timing that nobody ever explained to anybody. And I want to be honest about that number, the way I would want somebody to be honest with me. That is not a promise. Nobody loses exactly $41,000, and plenty of people have none of these accounts at all. It is an illustration of scale. It is what it looks like when several ordinary timing mistakes stack up in one household. Some of you will look at that list and recognize one item. That one item might be worth a few $1,000s to you. That is still a few $1,000s, sitting in a drawer, waiting on a decision. And the decision is free. That is the part worth remembering. And that is exactly what the quiet rules holds. Which accounts to check first? What to ask when you call? The questions that reveal a problem before it becomes a tax bill, and the order to handle them in, so nothing gets triggered by accident while you are fixing something else. For this, and for every account in this video, sitting in the drawer, in plain English, before the year closes, not after. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked. We ship because the alternative is what happened to every person in this video. A perfectly reasonable decision made in the wrong month by somebody nobody had ever warned. And if your own situation is genuinely tangled, if you have several of these and no idea which to touch first, email me. The address is on your screen and in the description below. I read every one. Now here is your checklist. 5 things, and none of them require a professional to start. 1. Find your savings bonds. Physically, this week. Check whether any have stopped earning, and do not cash a large stack all in 1 year. 2. List every employer you ever had a retirement plan with. Then search your state's unclaimed property database, free, under every name you have used. 3. If you own an annuity, call and ask for 2 numbers, what you put in and what it is worth today. Write them down before you ever need the money. 4. If you are past 65 and still contributing to a health savings account, stop contributing several months before you enroll in Medicare and ask specifically about retroactive coverage. 5. If you have money at a former employer's plan, make a deliberate decision about it. And if a check ever arrives from a retirement plan, do not deposit it. Call somebody first, that same week. Let me leave you with the thing I most want you to keep. Rufus cashed an envelope of bonds to fix a roof and paid for it 3 different ways. Leota was taxed on money she never received because a letter went to the wrong house. Cordelia thought she was withdrawing her own money and was withdrawing gains. Amos followed every rule and was made retroactively wrong by a backdate. And Hollis deposited a check, the way any sensible person would, and turned retirement money into a tax bill. Not one of them was reckless. Not one of them was greedy. Not one of them broke a rule they knew about. Every single one of them was holding an account that had been quiet for years, and quiet felt like safe. That is the thing I most want you to take from this. For these 5 accounts, quiet is not safe. Quiet is just the part before the bill. So go look. This week, while nothing is wrong, while every one of these decisions is still yours to make and still yours to time, the drawer is not going to open itself. And if all 5 of these feel like too much at once, then do one. Pick the account you have thought about least in the last 5 years and spend 1 hour on it. That is it. 1 account, 1 hour. Because none of the people in this video needed a financial expert. Every single one of them needed 1 afternoon and 1 question asked before the money moved instead of after. That is a thing you can do this week at a kitchen table with a phone and an old file folder. Baby, I'm Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.